Let's talk liquidity. As a beginner trader myself, it is crucial to use liquidity and understand it correctly. That's why I've made this short guide in order to understand it as best you can. First of all, what is liquidity? Essentially, liquidity is highs and lows in the market. It's as simple as that. Every time we create a new high, every time we create a new low, we create liquidity. These levels here. But it's important to understand what liquidity is important and what liquidity is not important. For example, on this chart here, we have all this liquidity sitting above these highs, these lows, etc., etc. But it's important to find out what is the most important area of liquidity. Now, if we're looking here, we have external range liquidity and internal range liquidity. Now, the key is to align both internal and external range liquidity. For example, if we have this external range liquidity here and we're approaching the level, what we want to see is the market take this level, draw back down, then take the internal range liquidity as well. Then we have both stacked external and internal range liquidity. Then what we can do is place a sell order off a fair value gap, which if you know ICT, you may know this. If not, I'll do a future video on it. But what we do is once we've taken out this buy side level of liquidity, we then look for an internal sweep of liquidity, which is just here. We look for an area in which we can place a sell order, for example, on a fair value gap, on order block, and we'll then target the opposing area of liquidity. For example, this external range liquidity here. So what have we seen? We have external range liquidity on the high and the low of the range. The price has come up, it swept the external range liquidity. We've created a new high here. We've swept that internally. We've waited for price to show us it wants to go down with displacement through the level. There'll also be some kind of change in the state of delivery or break of structure here, but I'm not going to go into that today. We then wait for a fair value gap to form, price to retrace into that fair value gap. We can enter, we put our stop loss around this level above this swing point here, and we'll target then the opposing level of liquidity. So as I said, the market is constantly producing liquidity. Highs, lows, every time it's producing liquidity. But it's important to find those important levels of liquidity. Now, there are certain levels which are a lot more important than others. For example, say this is the Asia range here. Okay, so we have the Asia high and the Asia low. Now, once we come into the London session, we are much more likely to take the Asia session low and reach for the Asia session high than any of the liquidity on the market. The reason for this is we have a lot more orders placed below this level and above this level here, that liquidity is naturally going to draw to these levels. That's what we call session highs and lows. The next key area of liquidity is data highs and lows. So when we have a news release at say 8:30 a.m, 9 a.m, we have a big spike in price, either up or down. We then create these two levels here. Now these are both data high and data low. Now price is much more likely to retrace to this low, to sweep this low, and then follow back up to the high than it is any of the liquidity on the market at that time. So that's the second most important area of liquidity, is data highs and lows. Now the third most important area of liquidity is equal highs and lows. For example, say the market creates 3 equal highs, just like this. The market is much more likely to draw to these levels and then continue downwards or upwards than it is any other liquidity on the market. Again, this is because we have more orders sitting above or below these areas than anywhere else. I think one of the most important things to remember from this video is if we take an area of external liquidity, you must wait for price to show you it wants to go down. There's no point entering a buy or a sell just because we take this level of liquidity. We must let price tell us that it wants to go low. This is with displacement through a level, a displacement through a high that was created just here. As I said at the start of the video, price is constantly forming and taking liquidity. Once we take a high or once we take a low, we are then targeting the opposing level of liquidity. For example, price comes up, takes this level of liquidity, and it's looking for the next swing point, which is this liquidity here. We then take this liquidity. We may or may not continue downwards. If we do, that's fine. We wait for market to tell us that it wants to go higher. So after it takes this level here, because it's the last low it creates, we are then more likely to cunt this level up here. I think that's wrapped up my liquidity video. I just wanted to do a very quick, simplified version of understanding liquidity. This is extremely important to use in your trading, and you must remember the market is constantly hunting and forming liquidity. I hope this video has been helpful. If it has, drop me a like, drop me a comment, drop me a subscribe, and I'll see you soon. Peace.